Hey guys, I am Deric. Welcome to my channel. In this video, I'm going to talk about efficient market hypothesis. Efficient market hypothesis, EMH. It is also called efficient market theory. EMH states that share prices fully reflect all information. Which means, when there is a good news, share price will go up. But if there is a bad news, share price will drop. Stocks are always traded at fair value, making it impossible for investors to purchase undervalued stocks or sell stocks for inflated prices. In other words, it should be impossible to outperform the market through expert stock selection or market timing. Whoever that is trying to forecast the share price to go up or down, their forecast will fail. The only way an investor can obtain higher returns is by purchasing riskier investments. However, the market is not always efficient. Let's compare the reaction of stock price to new information in both efficient and inefficient markets. Under efficient market reaction, when there is a good news, the price instantaneously adjusts to and fully reflects new information. There is no tendency for subsequent increases and decreases. But sometimes there will be a delayed reaction. It happens when the price partially adjusts to the new information. For example, 8 days elapse before the price completely reflects the new information. In other words, investors take 8 days to respond to the good news. Another extreme is overreaction and correction. It happens when the price overadjusts to the new information. It overshoots the new price and subsequently corrects. In other words, investors overly react to the good news. As such, we have 3 forms of market efficiency. First, strong form of capital market efficiency. It means current prices reflect all information, including historical, public, and private information that can possibly be known to anyone. So, there is no information that allows investors to consistently earn abnormally high returns. Even insider information is of little use. But, according to empirical evidence, markets are not strong form efficient. Second, semi-strong form of capital market efficiency. It means current prices reflect all publicly available information. So, abnormally large profits cannot be consistently earned using public information. Fundamental analysis is of little use. However, if the market is semi-strong form efficient, insider information or private information may help in making abnormal profits. But insider trading is illegal. Third, weak form of capital market efficiency. It means current prices reflect only the information contained in past prices. So, past data on stock prices are of no use in predicting future stock price changes. Technical analysis is of little use. If the market is weak form efficient, investors may make abnormal profits by conducting fundamental analysis. According to empirical evidence, markets are generally weak form efficient in most countries. As a summary, weak form includes all past information, semi-strong form includes all public information, while strong form includes all relevant information. Under strong form efficient, no investor should be able to earn abnormal return. Under semi-strong and weak form efficient, no investor can consistently earn abnormal return. If sometimes investors earn abnormal return, it's still possible. Random walks and efficient markets have some connections. Random walk hypothesis argues that stock price movements are random and unpredictable, so there is no way to know where prices are headed. Studies of stock price movements indicate that they do not move in neat patterns. It is unlikely to find a fixed pattern or equation for stock price movements. When new information arrives, prices react instantaneously to it. Since new information cannot be predicted, it would arrive at random points in time. Therefore, stock price movements would be random as well. This could be an indication that markets are highly efficient and respond quickly to the changes in the current situation. To have an efficient market, it is assumed that there are many knowledgeable investors active in analyzing and trading stocks. Information is widely available to all investors, and it is free and easy to obtain information. Events such as labor strikes or accidents tend to happen randomly. Investors react quickly and accurately to new information, causing prices to adjust. The following are the implications of EMH. First, in an efficient capital market, the transfer of assets occurs with little loss of wealth. So, when you buy or sell an investment, the loss in value will be minimal. Second, in such markets, prices reflect all available information. Thus, financial asset prices are fair prices, which means they are neither too high nor too low. Third, future market prices cannot be predicted based on available information. Fourth, stock price movements are random and unpredictable. Fifth, investors are rational, which means they receive, interpret, and react to the information in similar manner. Sixth, no one can consistently beat the market, which means it's impossible to consistently make abnormal profit. Abnormally high returns are earned by pure chance. Seventh, investments in these markets have a zero NPV. Specifically, the expected rate of return equals the required rate of return. And the expected rate of return compensates the investor for the risk borne. However, there are some common misconceptions about EMH. First, EMH does not mean that you can't make money from investments, or investments in the market are riskless due to correct price reflection. In fact, EMH will not protect you from making wrong choices if you do not diversify. Remember, don't put all your eggs in one basket. Second, EMH does mean that, on average, you will earn a return appropriate for the risk undertaken. And there is no bias in prices that can be exploited to earn excess returns. Alright, that's all for this video. Thanks for watching. See you in the next one. Bye.